So, Ray, thank you very much for coming and for writing this book. We're going to talk about this principally this evening. I wanted to start, though, by asking you this. You're running the largest hedge fund in the world. You started it about 47 years ago or so, something like that, right? The largest hedge fund, more than $150 billion. How do you have time to write books when you are running that hedge fund?
I didn't write either of those books, really. What I did was, this book was, in order to understand what was going on today, I needed to do a study.
Right.
And what I experienced in life many times before was that the surprises that happened to me were things that never happened in my lifetime, but happened many times in history.
Okay.
If you want, I'll tell you the story. But anyway, and also the first book I wrote down the principles as I was making decisions. So I find it very helpful when I'm making decisions to think about why I'm making those decisions and to write down the principles. And so I sort of log those things. Okay. And then there's a compendium of those. So that's how both of the books got written.
How long did it take you to write that book?
Well, the study took me about 2.5 years, but I mean, I was dealing with markets, I was dealing with life and all of those things during that tour. I've got a fabulous team of researchers, and I'm lucky because I could speak to most people.
Now, recently your CEO decided to leave, and he's going to run for the Senate. So Dave McCormick. So are you going to take on that job as well, the CEO? No.
No, thanks. He's a bigger and more courageous man than I.
And you're not thinking of ever running for office?
No, thank you.
Okay.
I'm not brave enough to.
So the essence of this book, now we'll go through the details a little bit later, but the essence of it, if I can summarize this entire book in one question, is that more or less the United States is on decline. Unless we do something to change that, we're going to have social disruption. We're going to have a currency that's not worth as much as we would like it to be worth. We're going to have debt that's going to be hard to pay off. And China's on the rise, and it's a rising power. Is that the essence of it?
The essence of it is that I'm going to explain it a little bit more than
more detail than I just did?
Yes or no.
Okay.
There were 3 things that happened in my lifetime that are happening now that didn't happen in my lifetime before and that I needed to study. And that was an enormous amount of creation of debt and the monetization of that in a financial piece. The second is the internal conflict, populism of the right and the left, and with wealth gaps and so on, that I like to measure things, that you'd have to go back to 1900 to see those degrees of conflict, which I think are a threat to our system and a democracy and could produce a civil war type of situation. Right. And third, the rise of a great power to challenge an existing great power in the existing world order. Now those 3 things in their degrees individually, but also collectively, last time they happened was 1930 to 45 period. And so what I needed to do was to understand those patterns and those things, and I took it into it. And so what I'm hoping to show is simply the mechanics of it in a lot of, and then explain why it appears that we are at an important juncture. Now, what we do at that juncture, so yes, it's measured, and the United States is in relative to decline by measures, which are measured, and China has been rising, and that's an issue, but that doesn't create necessarily a destiny. It creates a situation which I hope we can explore.
We'll go through that. Before we get into that, I want to go through some of your background, but also on this book. When you read the book, as I have, and I enjoyed it, it took me a couple sittings to get through because it's a lot of detail in here. You have a lot of historians that help you because a lot of history in here, history I didn't know. You have historians that help you?
I'm so lucky because I get to speak to so many people who are historians, who are practitioners, people in different countries, Henry Kissinger, Graham Allison, just scientists and so on, and then historians. And then I have a fabulous research team. So I go into this learning immersion, and I iterate with it. I show them what I've got, they come back, and that's the process.
Okay, so you have in here people who have said good things about the book, including a number of Treasury secretaries, Hank Paulson, Tim Geithner, Larry Summers. Hard to get 3 Treasury secretaries to agree on anything, but you did. You also have very favorable comments about the book from Henry Kissinger and Bill Gates. You know both of them?
Yeah.
All right, who's smarter?
Well, I think that they would say, each would say the other guy, and I think I would say that each in their own ways.
Okay. So, boy, you should go into politics or diplomacy. Okay, so let's go through your background. You grew up in Long Island?
Yep.
And your father was a jazz musician, is that
Yeah.
right?
Mm-hmm.
And you didn't want to be a musician?
No, I hated when he taught me. I hated scales.
Because of the steady work that you get as a jazz musician, is that the problem? Or?
No, just him teaching me to do the scales was not something that worked out so well.
So were you, as a young boy, did you say I want to be a global macro investor when you were?
No. It was in the 60s, and I caddied and I did odd jobs, but particularly the caddying, and at that time, the stock market was hotter than any time I've ever experienced since, by the way. You could get a haircut and everybody's talking about the stocks. So I'd caddy and I'd talk about the stocks. And I carried around, 2 bags. I earned $6 a bag, $12. I put the money together. I put it into the stock market when I was 12. But the kids, it wasn't such a precocious thing because everybody was sort of thinking about it. And the first stock that I bought was the only company I ever heard of that was selling for less than $5 a share. And my investment strategy is that because it was so cheap, I can buy more. If it went up, I'd make more money.
All right.
And what happened is it was a company that was about to go bankrupt, but another company acquired it. It tripled in value, and I said, "This game is easy," and I got into the game.
That was easy. Okay, so did you spend time studying the stock market when you were in high school, and were you a good high school student?
Oh, I was a terrible high school student, but I was addicted to the markets, right? Because, I figured there's the Wall Street Journal, particularly Wall Street Journal, but they had all these thousands of names, and all I had to do was pick one that went up or down.
So I guess you weren't a good high school student. You didn't go to Harvard or Yale or something like that?
No. I barely got into C.W. Post College on probation. I hated high school.
Okay, but you did well there.
I did very well there.
So ultimately you got into Harvard Business School.
Yeah, and I loved Harvard Business School.
And did you think the people there were smarter than you thought they'd be or not as smart as you thought they would be?
Well, they were smart. And they were interesting because they came from all over the world. And it was also fun. The dorms and having fun together and all that.
So you enjoyed it?
Oh, it was great.
Okay, so when you quit Harvard Business, well, not quit, you graduated from Harvard Business School, not quit, you graduated from Harvard Business School. What did you do? What was your job?
Well, I traded commodities all through earlier years because commodities had the lowest margin requirements. So I figured if I was going to make money, I could make the most money with those with the lowest margin requirements.
Let me make sure people understand. When a margin means you're borrowing money from a broker, right? So if you buy stocks, you can borrow, at the time, you can borrow, 70 or 80% in those days?
No. It was 55%.
In those days?
Basically, yeah.
Okay. And what could you borrow for commodities, though?
90 some odd percent.
So it's a good way to make money and a good way to lose money.
That's right.
Okay.
But since you're planning to make money,
right. Okay. So you did that, and you ultimately get to work for somebody else.
So I did that, and then in the summer of between 1972 and 73, and I was in business school. I got a job at Merrill Lynch I went up to the director of commodities. Nobody traded commodities, but Merrill Lynch had one. And I went up there and I asked him for a summer job. And so he gave me a summer job working for him as kind of his assistant. Nobody ever out of Harvard Business School would ever go into commodities, but I loved them. And then what happened is in that subsequent year, we had the oil shock, okay? And with the oil shock, the commodity markets went ballistic, the stock market went down, and I graduated school, and Dominic & Dominic, a Wall Street firm, hired me to be director of commodities. I never had a full-time job being director of doing commodities, but they hired me as director of commodities. Now,
You're the only person in the commodities department?
yes, I was hired to set it up, and they gave me this experienced guy. And before that could happen, what happened is their retail brokerage house sort of collapsed. Maybe it was a reflection of their decision making. And then I went to CBWL Hayden Stone, which, as you might remember, was the beginning of the morphing from Shearson Hayden Stone, and I stayed there for, I don't know, like a year and a half.
That was known as corned beef with lettuce.
That's right. That was what the
right.
CBWL, Kogan, Berlin, Weil, and Levin, corned beef with lettuce.
Right, okay. So you were there for a while.
Yeah.
And then did you get in a fight with one of your bosses somewhere and punch them in the face?
Yeah. It was New Year's Eve. We had a big party. We got drunk.
Oh.
And, one thing led to another. And
It happens all the time. Right?
And I decked him.
Okay.
Is
Is that the end of your job?
he went home. He was drove home. On the way home, he totaled his car. His wife chewed him out because they missed the thing. He didn't end up firing me for that time. It was another time.
Oh, another time. Okay. All right. Has he ever come to a job for Bridgewater? Has he ever come to you for a job?
He's a good guy.
Okay. All right. So then you start your own company, right?
Yeah.
And it went incredibly well at the beginning.
1975. It was me, a guy I played rugby with, in my 2-bedroom apartment.
Okay. And everything went well until it didn't go well.
That's right.
And did you then have to go borrow money from your father?
Yeah. So, yes. So what happened was, it was a very small company, just a handful of people, and I loved to trade the markets, and we did it for institutions. And then in 1979, 80, 81, I calculated that that the American banks had lent more money to foreign countries than the countries were going to get paid back. And I had its controversial view that the world, is going to be a big debt crisis. And Mexico defaulted in 1982. So very interesting, 1982. And when they defaulted, I got a lot of attention, and I thought we were going to have a terrible economic set of circumstances. And I could not have been more wrong. It was exactly the opposite. In August, when they defaulted and other countries started to default, it was the exact bottom in the stock market. And so I had to let off everybody, and I was down to me, and I said to myself, well, am I going to have to put on a tie and go take the train in and go to Wall Street and so on? I couldn't bring myself to do that. And I was so broke that I had to borrow $4,000 from my dad to pay the bills. And this was the best thing that ever happened to me. I mean, painful, but it was one of the best things that ever happened to me because it gave me the humility I needed to balance with my audacity. And then I needed to understand, how can I have the upside without having the downside? And then I understood portfolio construction and risk management and so on and so forth. So that was my bottom, and that punch in the face, that experience, was one of the best things that happened.
Did you pay your father back at some point?
The $4,000 plus.
He didn't want equity in Bridgewater? He didn't ask for that?
No, I think he was smarter than that.
So Bridgewater, where'd you get the name Bridgewater?
I was when I went to school, Harvard Business School, and we got out, I had these friends who went, this commodity time when there's this big shortage, oil shock and so on, and these fellows who I went to school with went to different countries, and they wanted to import different items. So, for example, Iran wanted to import soy oil, and I knew about commodities. So I said, okay, why don't we have an association, Bridgewater Associates, we called it Bridgewater because of that, and I happened to have the name, so that when the time came, I used it. It was set up already.
So for those who might be watching here now or later on, what actually is a hedge fund? I mean, we hear the term, but what is a hedge fund versus a mutual fund? What does it make? What's special about a hedge fund?
Well, what goes on under the name of hedge fund is like a lot of different things that go under the category of mutual funds. If you say mutual funds, what is a mutual fund? Well, they have all different things in common. The main things is that it's not a publicly registered vehicle, and it allows one to structure the portfolio to go long or short, different. It gives you a great leeway as to what you can do to also balance your risks and operate that way.
Now, like the business I've been in, private equity, hedge funds have one other thing in common, which is they get a carried interest, so-called, in the profits.
Yeah, we get a percentage of the profits, but not a carried interest.
Okay, percentage of the profits. Okay, it's the same thing.
Well, I mean, no, in a private equity, you'll have the piece of the equity that'll
Right.
carry through.
Okay.
What
Right.
we have is mark to market, and they pay us the
Right.
same idea but different.
Right now, you're managing 150 billion plus.
Yeah, about that.
And why is it? Explain this to me. I really don't know the answer. Hedge funds seem to come and go. Sometimes they're hot, sometimes they're cold, sometimes they go out of business. You've been in business for almost half a century, and you've got 150 billion. What did you do that nobody else has been able to do?
Well, what we were able to do was to be able to structure portfolios in a way that were better in terms of the returns, risks, and correlations of our investors. So to give you that an idea, in other words, you could balance things in a way. I could take different alphas, different bets in different markets, and I could carry that and put that in a fund called Pure Alpha. Then I could take different asset classes and put that in a fund which was called Pure Beta. And then we could engineer it for the customer's risk levels. Do you want it at 12% volatility, 18% vol? And then they would, whatever benchmark they wanted, we could put the alpha on top of. So they could say, I want the S&P 500 plus a 6% vol operating that way. I know it all sounds complicated, but we could design and structure things to their liking that would produce an attractive risk in return that also was not correlated with their other investments.
So let's suppose I knew you when you started, and I said, I want to be one of your first investors 40 some years ago or so, almost 50 years ago. And I said, I don't care about the volatility, just make me a good return and make me some money and don't take too big a risk. What would I have earned if I'd been with you from year one up to today? Would I be getting 8% a year over 40 some years?
Okay.
10% a year?
So you would have to specify your risk level, because the risk, here's what almost always goes wrong. We've been doing, let's say, Pure Alpha since 1991, so it's 31 years. And what goes wrong is the risk of ruin, right? And so you can't have a risk that is greater than you can have, I'll call it a 2 standard deviation, but you can't have a risk that's going to knock you down, let's say, 40% or 50%, because if you lose 50%, you have to make 100% back. And so to engineer that, so in our particular case, you would have earned, since 1991, you would have earned 12% a year. You would have earned money 85% of the years. Any losing years, 5 losing years, but only small losses. The biggest loss we had was because on COVID of 2020, we lost 12%. And that return would have been uncorrelated with the other investments, so it would have been a good diversity.
People who invest in your fund today, are they?
That's Pure Alpha.
Are they big institutions?
They're institutions.
Not individual. If I call up your Bridgewater telephone number and say I want to invest, you can't do that.
No, we don't do that.
Okay. All right. Okay. So
that's the Pure Alpha fund. So alpha means that you could take that, and if you say I want to put that on top of the S&P 500, you can get that. Blah blah blah. And then there is, then what is your asset class, which we call the all-weather fund, and that's a strategic asset. So those are the 2 styles of investing, and we tailor it for those clients for their risk and what they like.
Now, you wrote a book a few years ago called Principles that sold millions of copies. Usually books in the business world don't sell millions of copies, and millions of them were sold in China as well. What is it that was in that book that was so exciting to people? You have a set
what
of
I
principles.
This is kind of like how I think and what I do. And I recommend this to everybody. When I would make decisions, I would not just make the decisions. I would think about what are the criteria that I would use to make the decisions, and I'd write them down. Those are the principles. And then in our culture, which is this idea of meritocracy, we would say, are those criteria good or bad? And then we would try to put them into algorithms and equations. And so I would do that almost like a diary kind of thing. And I would see the same things happening over and over again. And the next time it happened, I would go to the principle, and we could together go to our principles. And so it accumulated that over a period of time, and they were practical. They're not theoretical principles, and people seem to find them valuable.
Now, it is said that you use these principles in your firm, and you operate the firm according to the principles, right? More or less. But it's very constant self-examination. Employees have to be self-examined by their peers. You're self-examined by your peers, right? Or other people in the firm. It's hard to get people to want to do this and to want to be examined so intently over the years, or is that easy?
It's so logical, but that doesn't mean everybody wants to do it. So in one sentence, it's an idea meritocracy. You know, the best ideas win out from wherever they come from, in which the goals are meaningful work and meaningful relationships, that we're in it together, through radical truthfulness and radical transparency. Right. So if we disagree, that's a good thing. That's no reason to have anger. And to have the art of thoughtful disagreement and examine how do you scientifically find out what's true? How do you test things and so on? And that's been essential to our success.
Okay. So, you know, you're very intense, you're obviously into the numbers, but you're also big into transcendental meditation, right?
Yeah, that's helped me a lot.
It's
been probably the biggest, whatever success I've had, maybe more attributable to transcendental meditation.
And how did you get into transcendental meditation? The Beatles help you or something?
Yeah, yep. It was exactly that. In 1968, the Beatles went to India and they meditated. And then I heard about it, and then in 1969 in New York, you can bring some flowers, and you could do that, and you could learn how to meditate. And wow, I recommend. It's the best gift I could give.
You do it every day or every?
Almost yeah. I try to do it every day. I try to do it about twice a day. And if I could take a second to describe it, what it is it frees your mind of thought, and it takes you from a conscious state into your subconscious. And your subconscious is where creativity comes from, and equanimity and all of that. Like if you're calm and great ideas come to you. And when you have that equanimity, then as you're approaching everything, things are just the way they are, and you have to deal with them. And it's a little like being, you know, in the ninja movies, it's a little bit like being the ninja, and everything seems slower and you can handle it better. Right. And you align your subconscious, which is where the emotions and also inspirations come from, with your conscious mind. And when they're aligned and you have that equanimity, it's a great thing.
You're going to write a book on transcendental meditation?
No.
Okay, so let's talk about this book, okay? There are, the essence of it, again, summarizing a little more detail than I did before, your view is there are three big cycles in history. Is that fair, more or less?
Yeah, I came with the three things that are happening today, and then I found that there are really five.
Okay.
But the three big ones, yeah.
All right, so let's go through the first cycle. The first cycle is when an economy comes together, gets wealthy, people are building up the economy, and eventually they build it up so much they borrow more money than maybe they should, and they dilute their currency. Is that fair?
Yeah, I could do it in a quicker way.
Quicker than that?
Well, better than that.
Better than that, okay, no doubt.
There's a new order. There's usually some fight between the left and the right, or it could be foreign countries and whatever new order. And then when that begins, it's sort of a great equalizer. And capitalism is a fantastic enabler, because what it does is it gives people who may not have anything, who have good ideas, capital, so they get the resources to pursue that, and that's a fabulous thing. And then as it rises over a period of time, you'll see debt to income ratios rise and so on, because everybody gets more funded, because debt is buying power and everybody wants more buying power. And then also you see it naturally distributes wealth unequally. and it distributes opportunity unequally. So as that wealth gaps rise and widen, and then also because it's parents who have wealthy parents can educate their children in an unfair, let's say an unequal way relative to others. And so, but it gets overly indebted. And then because all this buying power, which comes in the form of debt, is somebody else's assets, then what happens is then you lower interest rates, you try to stimulate it. So for example, since 1980, every cyclical peak and every cyclical trough in interest rates was lower than the one before it so that they can stimulate more debt. And then when you get to zero interest rates, that doesn't work. So they have to print money and they buy money to get that pile going up. And that creates the cycle, okay? So there's part of that cycle which is a capital markets and by the way, this exists almost everywhere. And then with that, and then you see the monetization of debt and so on. And with that, there are also conflicts that are the wealth conflicts, and related to that, the political left and the political right. And then that creates the dynamic that we're talking about.
Okay. Now, you cite in your book two examples where this has happened before. One is in the Netherlands, where the Dutch economy, ultimately, they had the only reserve currency, at least in Western Europe, the guilder, and they did some of what you now say we're doing. Is that right?
Yeah, the same patterns over and over again. They had, in the beginning, big education, they won a war, then they became very competitive, they went out in the world taking their goods, and they built ships that were the best ships around the world so they can go anywhere in the world. They brought their arms with them and they made a fortune. And with that, they brought their currency. And as they bring their currency, because it's a world currency, a reserve currency, others want to own it. And because others want to own it, because that's buying power, it's the common wampum, and then because of that, then they lend it to the Dutch. So in other words, Americans get lent money because others want to hold dollars, and then that allows us, that's the exorbitant privilege, to get more and more in debt. And then what happens is they lose their competitiveness. The British came along and copied from the Dutch and found, they could make ships better and cheaper. And then they became the competitors. And then as the competitors are operating, they take market share away, quite similar to lots of technology companies and what's going on now. And then what happens is then they get more in debt, and then they have the other cycle that's operating, and then you have the challenges of that.
So they had the Dutch, they typified by the Dutch tulip bulb craze, where people were spending a lot of guilders buying tulip bulbs, right? So that imploded, and the British came in and they built a big economy, and then they kind of went south a bit. They had the
same
reserve
exact
currency.
pattern.
And then we came along, the United States became the biggest economy in the world around 1870, and since World War II, we've been the dominant economy. So now we have a lot of debt, you'd say?
Yeah.
29 trillion?
Good.
About that. So how are we going to pay off that debt, by the way?
Well,
inflation is the only way?
In the end, it's always print
Inflation.
the money.
Okay.
You know, it's always print the money, because you see, one man's debts are another man's assets. And so if you're holding a bond and you receive you don't get compensated for inflation. Let's say people think cash is a low risk investment. Well, they're earning no interest. And when you have a 7% or a 5% inflation, you lose 5% of your buying power. Or if you're owning a bond, you have the same thing. And so what happens is, not only is there the debt that is coming from the new debt created to run the deficits, but there become sellers of that debt, because the owner, as an asset, it's not a good asset. And then there's so much selling. And what that means is that you either have to, interest rates have got to go up, and then that grinds things down to a close, or what they do is they have to print money. And so the history of all of these cycles is that the coffers are empty, because you can't continue to spend more than you earn and give it to somebody, expect them to like it, and then you devalue it, and that becomes the cycle. And so you see the classic cycle of the ingredient is the cycle I'm talking about in terms of supply, demand, and the
All right.
debt.
Well, you point this out because, one, you want people to know that we're borrowing too much money and we're devaluing the currency, just so the policymakers will maybe do something?
No, it's not that easy.
Why do you want to tell people this?
I only want people to look at it with me together, to see, do we agree on the mechanics and do we agree on history, so that there's awareness for individuals, because I think individuals, what do they do with their money and how are they going to do? I just want to pass it along. I'm at a stage in my life, I just want to pass that along and decide that. But I think also, if you understand it for a society, it's not easy, because there are very big issues. We are bad, and our infrastructure is bad. Our educational gaps are enormous. I have personal contact with my wife working in the poor school districts in Connecticut. Let me give you the example. In Connecticut, which is one of the richest states in the country, 22% of the high school students are disengaged or disconnected. Disengaged means that their missing absentee rate is greater than 25%, and they're failing classes. That's disengaged. Disconnected means that they don't go to school, they don't know where they are. 22%, 1 out of 5 is there. If I'm in, and if I live in Greenwich, Connecticut, average school district is $24,000 a year. It's in Bridgeport, it's about $14,000 a year. These types of issues, and then infrastructure and so on, they are issues. So I'm not saying that the issues don't exist. It's a very easy thing to say not to pay the money, but if you look at the cycles, you have to come up with the money, and when a society as a whole is spending a lot more than it's earning, and to not be aware of that, either for the purpose of the society or for the purpose of individuals thinking, how do they take care of themselves, I wanted to pass it along.
So what you wanted to do is presumably let people know this is occurring, so maybe they could take action by letting their congressmen or governors know something about this, or not?
Well, I think there are two things. What you can do to make a better society, and what you can do to make a better society in your contribution, but also how you can individually take care of yourself in a situation that might be difficult.
Okay, so let's finish on the third part of the cycle. The third part of the cycle is somebody's rising up, and right now you would say China's rising up. Is that correct?
There's just numbers, and you look at it, and
okay. So if I want to do something about it, and I want to live in a time when China is not rising up so much, and we're better off in the U.S. economy, what should I do? Should I lobby my members of Congress not to print so much money? What should I do about it, if anything?
Well, again, it's
the cycles are such you can't do much.
I think if we go back and we look at history, there are three main things that you can do. Okay, first, as a society individually and then collectively, how do you earn more money than you spend, and how do you build a balance sheet that has more assets than liabilities? That's a healthy, and so keeping that in mind. The second is internal conflict or cooperation. Can you have internal cooperation because you realize what the consequences are? So I think that in the 2024 elections, there is a reasonable chance that neither party will accept losing the elections. And that is something that means that democracy, or a type of civil war of sorts, could develop in a way, this is realistic, I'm not being exaggerated by that. And when one looks at those types of things, there is a worry that one should have about the divisiveness and what it means for each other. And the same is true internationally. So basically, if anybody who has gone into wars, this through history, the people who are the most convinced that that's the thing to do all regretted going into wars because of what wars are like. So the things that I would hope to convey is, first of all, what are the arcs? Is that right or wrong in the arcs? Measured, not opinionated. Just look at those measurements so that you could see that. And then as we think about it, like I have a principle. If you worry, you don't have to worry. And if you don't worry, you need to worry. And what I mean by that is, if you worry and you start to think what this direction could be and what it's like, then maybe you deal with the things that prevent those worries where if you don't worry, maybe you get into trouble without worrying or with a confidence. One of the arcs is also people who've never been through a war. You know, our memories are with us, not necessarily our parents' memories. And because of those conflicts and so on, they take for granted the fact that we couldn't have a conflict, those types of conflicts. So those are the things, there are things we can do. The world has now more resources than it has ever had, and there are things that can be done.
Now, you are an early proponent of China being a growing economic power, and you've spent a lot of time in China. What do you think China thinks of us right now as an economic power? They think we're declining, or they think we are a big rival for them economically for a long time in the future?
I think Americans, people in other countries, and Chinese and so on would all worry. I think you're of an age, and I'm of an age to know.
Exactly the same age.
5 days apart, by the way.
Right.
Of an age to know that this is not the way it was in earlier years, and to worry about some of the things that I'm mentioning.
Okay, let me ask you this. The average person watching right now probably doesn't have $150 billion to manage the investment of. So what can the average person do to invest reasonably well?
Well, you know, like I didn't have any money, and I remember the cycle. And what it was is I would start to think, how much money do I have how many weeks, months, and then years can I take care of myself and my family? And I would calculate that. I would be at, 52 years, if no income was going to come in. And then I would start to think, and then if I'm holding a portfolio in something, maybe I could lose half, so I better cut that number in half. And then I start to think of what are my uses of the money? What do I need to do? And I would think about how do I immunize that? And you start and you build like that, and you know how to save. And saving, you know things like don't put it into cash deposits that get eroded by inflation and taxes and so on. And you start to develop it. And the thing that you can do, the most important thing you could do is not be in cash and those deposits, particularly now when there's such negative real rates, and to have a well-diversified portfolio. And that well-diversified portfolio, that's a whole subject of what does that mean and how to do it, but it's a well-diversified portfolio of not just asset classes, but of countries, of different currencies.
Diversified, but let me ask you, an average person who isn't, a billionaire, should they expect to get a rate of return overall on their money of 5% a year? Is that a good target? 6%, 8%? What do you think is a reasonable target for somebody who doesn't want to take undue risks?
Well, nowadays the structure of the markets and where everything is priced, and done the normal way, will give you probably a return in the vicinity of, with a lot of risk around it, maybe in the vicinity of 4%,
okay.
4%. Okay, something that might not equal inflation, probably it'd be very close, and then you have to pay taxes on it, because there are so many financial assets. But one thing you can, they'll send you more money.
So Warren
And they'll print it.
Warren Buffett famously has said that in the end, you're better off to go into a stock index fund than in a hedge fund, and he's made bets about that. Obviously, he's not an investor in your fund because he would have done well, but do you think an average investor who doesn't really know the markets, should they just go into stock funds or bond funds? Is that the safest thing for most people?
In any one thing, you have to understand, like from 1966 to 1984, the stock market had a negative real return. Went down 54% till 82, okay? And you could lose a lot of buying power. Any one thing, just please understand this, any one thing is a risky thing over probably a relevant time frame for the individual. And that's why knowing how to balance a portfolio, knowing how to achieve that balance, the thing that's magical about it is you can reduce your risk without reducing your return.
Okay. As we talk today, the stock market in the last couple of weeks has been correcting, if that's the right verb, and a lot of the air is out of the so-called bubble. Should people be selling everything and getting out of the market now because the markets are going down, or is this the time to buy?
First of all, I'm not here to give a lot of advice, but I'll give you the following thoughts.
We won't tell anybody. Just give us a
okay, just on our own. What's happened is they produced a lot of debt and gave out a lot of money, and so everybody's got money, and it's also very easy to borrow money to buy things. And as a result, if you create much more buying power, then you create goods and services. You've got a lot much more inflation. And the Federal Reserve has been behind the curve, slower to tighten monetary policy. And as a result, we're now starting to see the rise in interest rates to be able to deal with that. As that happens, all assets compete with each other. So now that free money is still going to be cheap money, but it's going to be a bit higher. So interest rates, let's say bond yields, have gone up about 1%. Now you take that and you adjust, everything is the present value of future cash flows, but it means that that interest rate goes up 1%. That means all the other assets have to adjust. We're in a process of making that kind of adjustment. That means the days that we've had before, the easy days where they dump money on you and you don't have much inflation and you don't have much tightness, those are past. And now we're in a different kind of part of the cycle.
Okay, so you said earlier that you're in the stage of life where you're basically giving away money. You're an original signer of the Giving Pledge, and you've decided to give away a lot of money. What areas are interesting to you in philanthropy?
Well, we do it as pretty much a family activity. You know, we have different, my wife, in my case, there are a number of things. I grew up in a modest background, and I like finance. So I like microfinance. I support Grameen America, for example, and those that produce microfinance. My wife and I are dealing with kids who can't get through education. We're trying to support that in those various ways. I have a passion about ocean exploration. 72% of the world's surface is ocean, and it's not been explored, and so I support various ways the creation of ocean exploration. Mental illness is a very important subject to us. There are, and then in our family, each has their own particular things. So it's, we went in COVID. We set up a clinic with New York Presbyterian Hospital for health justice, which reaches out to a population. Right. It's a little bit of.
So you're not investing, and you're not transcendental meditating, and you're not writing books and doing philanthropy. What are you doing? You have any outside interest?
Number one is my grandkids. Okay, my kids, my family, of course. And one of the greatest blessings in life that one ever can possibly have is one's school.
How many grandchildren do you have?
I have 4 now.
What do they call you?
Papa.
Not Mr. Dalio or something like that? All right, so I wouldn't be surprised that this is the first question that I've been asked to read you. How do you foresee crypto impacting the world order? Crypto
is an alternative currency, and then there's a digital technology, and then there's something like Bitcoin, which could be viewed as let's call it a digital gold. I think it's interesting. I have a tiny percentage of my portfolio on it to diversify, but I wouldn't call it, and it's, by the way, an amazing accomplishment to have programmed it, to have it 11 years, that it has not been hacked and that is used. But it is a very vulnerable incident because they can track who is operating on it. It can be tracked. It'll be outlawed probably by different governments. And in terms of its size, it has issues. So I think too much attention is spent on crypto, or somebody might be a gold bug, or somebody might be, I don't know, they hold gems or whatever they do. But I think that we're now in an era where we're going to have different types of money. We're going to question Money is a medium of exchange, but it's also a storehold of wealth. And we're going to be questioning what are the right storehold of wealth in the value. And you're going to see around the world, not only the digital versions of that take place in many forms, you're going to see other forms of that competition, I think, in the years ahead.
If you were starting out today, this question is, what would you do to build wealth if you wanted to build wealth?
Same thing. I'll tell you. There's work for it, and then there's think about what is your game. What do you love? So I would say, first of all, make your passion and your work the same thing, and pay attention to the money part. If you have a passion, a game that you love, and so you don't work, and that and it gives you an adequate amount of money so that you get what you want, out of life, then that's a good thing, whatever it is.
What's the single greatest tool you have used every single day that has contributed to your success?
Meditation.
That's it. Suppose you hadn't done that. You would have.
I'd probably
don't know where you'd be. Okay.
I don't know.
Okay. So how would a U.S. response to a Russian invasion in Ukraine affect markets?
Well, it's increasingly making investors think of what is a war market economy like? How do markets perform in wars? Because they're not used to wars, okay? I don't think it's going to be a big war, but I don't know, I don't know about such things. But it is good to know how do different monies work in that. So I think more attention will be paid to those types of things. And there's a description of all the past wars and all the markets movements in those wars in the book. So I would direct people to that.
What is your 2022 gold forecast?
You
don't.
I really can't say.
Okay, you can't say.
I would say it can become a more interesting year because, well, I could maybe describe 22 and 23 and 24 for you if you want, but it's more interesting. There's no one market that I would make a forecast of.
So as you look at your daily day, you're investing, you're writing, you're thinking, what gives you the greatest pleasure other than your grandchildren? Is there something that you like to do the most? Is it transcendental meditation? Is it looking at the markets? Do you look at the screens all the day to see where the markets are going, or you don't do that?
Learning and practicing, I'm excited to be able to speak with interesting people like yourself and on this eclectic world, and then to kind of bet on it based on what I do. Yeah, that's exciting. You said other than my grandkids.
Now, your mother died when you were relatively young, is that right?
Yes.
But your father, did he live to see your success?
He was 91, and success is not. He saw that I was successful, and successful, I think, means self-sufficient, could take care of the family, and a contributor to our society. I think he could make that judgment.
He didn't say if only you played a musical instrument. He didn't say that.
No, since I grew up, he said never be a musician.
So your advice to young people who say, I want to have a career like and a life like Ray Dalio, what would it be? What are the one or two things? Read a lot, be nice to people, study hard. What would you tell young people?
Know your nature. Know where your pull are. We all have different natures. Our minds work something differently. Know yourself. Like personality profile tests, I put out a test called Principle U. It's free for anybody who wants it, and it helps people understand themselves and where is your nature and what is your path given that nature. People should never live after somebody, but you should know your nature and pursue your nature, I think.
Ray, I enjoyed reading this book, and I've enjoyed our conversation. This is The Changing World Order, Why Nations Succeed and Fail. Ray Dalio. Ray, thank you very much for coming here today.
Thank you, David. Thank you.